Today, I want to talk about how the market crash is starting, and also who will be the first to snitch on Ken Griffin, Citadel, and other higher-ups as times and as people get more and more desperate. So stay tuned and let's make some money. And now to dive straight in with the key information. So, as Autism Capital tweeted, they said Sam Bankman-Fried is testifying without a jury present. Judge Kaplan sent the jury home because he says there's some information they should not hear. That's not Sam sending home his lawyers, that's the judge sending home the jury that should be making a decision as to whether Sam is guilty or not guilty. But supposedly there's some kind of information this jury should not hear. But John replied saying, wait, isn't the point of a jury in a jury trial to hear and examine the evidence so they can properly and fairly render a verdict? What kind of evidence should be kept away from the jury making their decision, and why should it be kept secretive and separate? He said, what, is something classified as top secret or a sensitive national security issue or something? Maybe Sam has some additional information that he's willing to hand over, just not in front of the jury. And Investor Turf has also added something very, very interesting, saying according to an ex-Southern District of New York prosecutor, Caroline Ellison, Gary Wang and Nishad Singh are likely to avoid prison entirely because they cooperated with federal prosecutors in the United States versus Sam Bankman-Fried case. So even though Caroline, Gary and Nishad are likely very guilty and defrauded the public out of billions of dollars, they're avoiding prison entirely because they complied and handed over information. They're not just getting a reduced sentence, it's not like 20 years down to 10 years or 20 years down to 5 years. They're literally going to spend 0 days in prison. They must have had some very juicy information to hand over and to cooperate with, and I wonder if Sam will do the same. But as the ape Jeremy from Utah tweeted, he said, get your AMC popcorn ready, folks. It's going to get really interesting as everyone starts turning on each other. Because it's not just Sam Bankman-Fried that's turning, because remember Do Kwon recently subpoenaed Citadel Securities for their involvement with Luna and UST. And Citadel Securities has just responded in a scathing fashion. Citadel have said to deflect attention away from these allegations, Terraform uses a motion to compel to pursue a ridiculous conspiracy theory exposing the purportedly hidden role of Citadel Securities in its self-imposed disaster. Citadel have said they had no involvement in the collapse of UST and of Luna. They've said they couldn't possibly have done it, and they only engaged in 2 test transactions with a total value of roughly 13 cents. It will be interesting to see if Citadel file a specific motion to dismiss, because surely if they have nothing to hide, they wouldn't mind being subpoenaed for information, especially if that information proved their innocence. But obviously if they're not innocent, they'd try and get the motion dismissed so they didn't have to provide that key info. But as Ape Jeremy said, I think as more and more time goes by, more and more people are going to become more and more desperate and start turning on each other. And that's because the S&P 500 is currently taking out its final area of support before revisiting those October 2022 lows and setting new lows. Signing up to Moomoo is easy and it's free, it just requires that temporary deposit, and it's a really great way to help support the channel. Even if you already have a separate broker that you hold your AMC shares in and trade with, I'd really appreciate it if you did sign up to Moomoo just to support the channel. Also guys, you can currently get a whopping 15 free shares valued up to $2,000 each. All you need to do is sign up to Moomoo using the link in the description below and make the required qualifying temporary deposit. Here I've drawn out the previous trend channels for the S&P 500 and also this key support line the S&P 500 is currently testing. Obviously through 2022 the S&P 500 was moving downwards very significantly, where we saw a number of hedge funds being liquidated for a variety of reasons. So far through most of 2023 the S&P 500 has again been moving upwards until obviously its peak around July time. Since then, the S&P 500 has entered into this new trending channel, obviously trending downwards, and it's currently revisiting this support around 410. Now this 410 area is actually really key. Over the last couple of years, it's acted as support and resistance a number of times. You can see here in April and May of 2023, it acted as both resistance and then support. Previous to that in February, it acted as resistance. Prior to that in August 2022, both resistance and again support. Prior to that in April, again resistance and support. Prior to that in March, again it acted as support. And it even goes as far back as acting as resistance back in June of 2021. You can also see from this tweet from D-Book Trading, the S&P 500 is also currently at this volume shelf. That means right now there's tons and tons of volume, and this should act as very strong support. So either we're going to see a bounce right here, right now, or the market crash really will start. As Morton GME tweeted, he said looking at the S&P 500 today, it was again pumped into that margin call territory time. Coincidence? It is not. Obviously today we didn't see any of those margin calls, but I think these hedge funds are definitely going to be more and more stressed as we work our way through this support and the market crash really does resume. Don't forget these hedge funds are still very long on the market, and obviously many hedge funds did go under in 2022. So if we do revisit those October lows and set new lows, more and more hedge funds are going to burn. And obviously as more and more hedge funds start burning, I don't think it will be long until some of these bigger figures start snitching on higher ups to save their own funds. This tweet from Dave Lauer is also very interesting, and it talks about a new ruling where these hedge funds can't simply accept that acceptance waiver and consent. He tweeted saying, and here's one of the most significant changes I've seen from an enforcement division in recent history. He said the no admit, no deny stance isn't given anymore. He said we're likely to see more cases where entities are forced to actually admit guilt, especially where facts are contested. Now this ruling says in light of these considerations, the division will take the following approach to admissions in the resolution it recommends to the Commission, saying in negotiations, respondents should no longer assume that no admit, no deny resolutions are the default. Rather, in each case, the division will discuss with the respondents whether admissions are appropriate. That basically means going forward, these hedge funds can't simply accept that acceptance waiver and consent, admitting to no wrongdoing, but paying a tiny fine. These hedge funds, market makers, institutions, and anyone else in the finance space will now actually have to admit their wrongdoing and face full punishment, whatever that punishment may be. He's added saying the regulatory tides are changing. The CFTC is sending a clear message. Higher penalties, stricter monitoring, and clearer admissions. Again, obviously we'll have to see how this plays out and if they do just continue receiving these tiny fines. But what is more guaranteed is the fact the S&P 500 is indeed testing this key area of support. And if that support does break, all hell will indeed be breaking loose. Obviously, if that 410 support area does break, then next up you've got that whole number $400 area of support, and then after that it just gets more and more messy. And finally, Dominic also tweeted about a little heads up for the new AMC filings. So obviously over the next few weeks we're going to get many Q3 filings from institutional investors holding AMC shares. He said what you should expect is a steep decline in these funds that are holding AMC shares, obviously due to the 10-for-1 reverse split. We've already seen a number of funds that are reporting 88% less shares, 78% less shares, 85% less shares, and so on and so forth. But actually that technically means these funds have added to their AMC positions over the last quarter. Because obviously due to that 10-for-1 reverse split, we should expect a minimum of a 90% drop in their shareholding. So obviously 10-for-1 being a 90% decrease in shares. So if they've declined less than 90%, like 88%, 78% or 85%, it means the respective funds have actually added to their AMC positions. But obviously declines of more than 90%, like 91%, means they have actually sold a few extra shares on top of that. So when you start seeing more and more funds reporting an 80% drop in AMC shares, it doesn't mean institutions are selling. It means actually institutions, weirdly enough, are still buying. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.